Hello everyone, welcome to our channel Brilliant Bankers, where you can expect in-depth classes on exams conducted by IIBF. Myself, Nishant, and today we will start off from where we stopped the previous class. Welcome to our class on bank financial management. Forex dealing rooms. The Forex dealing room, it comprises of a service branch for meeting the requirements of customers to buy and sell foreign currencies, manage foreign currency assets and liabilities, manage their funds, and also manage their nostro account. A dealing room acts as a separate profit center for the bank and its institution. While conducting the treasury management operations relating to the forex operations of the bank, the treasurer can ensure that the operations are in compliance with the internal control guidelines of the RBI, the FEDI regulations, and the internal guidelines of the banks. As said, it acts as a separate profit center for banking institutions. The foreign exchange dealing room can be divided into three types: the front office, the mid office, and the back office. So, what is a front office? What are their main duties? A front office dealer maintains two positions. One is the fund flow position and the currency position. What is a fund flow and a currency position? The fund position indicates the inflow and outflow of the funds. Any mismatch in the receivables or payables, that is whatever you want have to get or anything that you have to pay, will bring a negativity in the interest rate risk in the form of a possible overdraft in their nostro account, which is held in the other country. I think everyone is clear about what is nostro and vostro. Right? So any mismatch, whenever there is a deficiency or a hike in the foreign exchange held in our hands, there is a problem of interest rate risk. What is the currency position? The currency position, it deals with overbought and oversold positions. When Mr. A wants only 500 US dollars, but he has 700 US dollars on the EOD for today, and the next day when the market opens, he finds the value of US dollars has decreased. What happens? Automatically, there arises a problem of exchange risk. So that is what is meant by currency position. So what are the main duties of a front office person or a dealer in the front office? That is fund management of the nostro accounts, forex advisory management, maturity mismatches, checking the maturity mismatches, dealing in the interbank market, and compliance of the rules and regulations in the as set by the bank and RBI. What is a back office? It takes care of processing of deals, accounts, and reconciliation of accounts. This function is equal importance. Any laxity in the area would also land the institution into unforeseen troubles. Either it may make the efforts of the dealers to generate profit, or it could be so lax that the dealers indulge in misreporting or wrongdoings without the notice of the banks. So, what happens if a dealer is doing something without the notice of the bank? Automatically, is doing something wrong. There is always a big risk in the market. So, what are the risks that arises from the back office? Risks arise because of the confirmation of deals, delay in settlement of deals, accounting of deals, if there is no proper reconciliation, if there is no proper audit facilitation and reporting. These are the main jobs of the back office. And again, the compliance of the rules and regulations. What is a mid office? It deals with the risk management and parameterization of risk for the dealing room operations. It acts as a check of the risk taken by the dealers and also supplements them with by giving the market information. Mid office is also supposed to look after the compliance of various guidelines, instructions, and it's an independent function. It is an independent function, but equally connected with the front and the back office. So what happens with the mid office? It has market risk, it has a liquidity risk, it has a country risk. So all kind of risks are directly affected in the mid office. And the reporting to the top management is done by the mid office personnel. The management and control of RBI has advised the board of directors to frame an appropriate policy and fix suitable limits for its dealing operations, like setting the time and what are the time period when the forex transaction has to be carried out. As in India, it is carried out between 9 to 5. So these are few things that are fixed, and RBI has instructed the board of directors of all banks and the people authorized to deal with the foreign exchange to deal with this. The management of the dealing room operation should focus on risk associated with forex dealing, which arises due to complex nature of foreign exchange market and the volatile nature of the exchange rate movements. So, what are the different type of risks that may occur in the forex market? Operational risk. So, what is operational risk? It is a risk that is arising on account of human errors or technical faults or infrastructure breakdown or faulty systems. If you all know, in somewhere around 2021 or 22, there was a major glitch in NSE where they had to shut down their market for almost 5 to 6 hours. The glitch happened about somewhere at 11:30 in the morning, and the market was reopened at 3:45. Jabki that was the closing time. That was the closing time of the market. 3:30 the market usually closes, but 3:45 the market was reopened and it was run till 5 o'clock because of the major glitch, which is a very big operational risk. This is the example that I can give for it. Operation risk. What is the exchange risk? It's the most common and obvious risk in foreign exchange dealing operations and arise mainly on the account of fluctuation of the exchange rates and or when mismatches occur in assets liabilities. Example, the risk is usually more when international investments are made or under foreign currency borrowings. The rupee always depreciates against the US dollars and crossed the level of 83 in November 2022. That is, you are taking some amount in foreign currency. What do you think? The foreign currency should go down or go up? So there is an exchange risk. As said earlier, whenever you have an excess foreign currency with you, and when the value of that goes down, or you think the Indian rupee is going to go up and Indian rupee is going down, there is automatically exchange risk. So what is a credit risk? It is a risk of loss which arises due to inability and unwillingness of the counterparty to meet the obligations at maturity of the underlying transaction. It's clear it is the unwillingness of the counterparty to meet the obligations at the maturity of the underlying transaction. So whenever there is it's classified into pre-settlement and settlement risk. So something has been promised that at the end of the trade, the settlement will be done. And the trade has been executed on a credit basis. When the payment is not done, it's a credit risk. Coming back to settlement risk, it is a risk of failure of the counterparty, again during the course of settlement, due to the time zone differences between the two currencies to be exchanged. So time zone differences I can easily explain as the markets in India close the markets in US are ready to open. So there is always a lag in the transaction. So when first the transaction is started from India, and by the end of the day, we will close down, and only after that the transaction is carried forward in US markets. Liquidity risk. Liquidity risk is the potential for liabilities to drain for a bank at the faster rates than assets. There is mismatches in the maturity patterns of assets and liabilities give rise to the liquidity risk. Thus, it is a risk which may arise due to the party to foreign exchange transaction unable to meet its funding requirements or execute a transaction at the reasonable price on the maturity or due date. What is the interest rate risk? A bank buys and sells currencies for spot and forward value. It may not always be possible for the bank to match its forward purchases and sales. If the purchase and sale takes place for different value dates, while the bank may completely stand hedged on exchange front, it creates a mismatch at the future date between its assets and liabilities, which is referred to as a gap. That is the gap risk or the interest rate risk. What is market risk? The risk that arises due to the adverse movements of markets. There is example exchange rates and interest rates. When the players are unable to exit the position quickly, market risk takes the form. And the different forms of market risk are interest rate risk, equity price risk, current risk, legal risk, system risk, country risk, and the sovereign risk. These all come under the market risk. The major risks are operational, exchange, credit, settlement, liquidity, and the market risk. Authorized dealers are the institutions that have the license from RBI to buy and sell the foreign currencies. Mostly the authorized dealers are banks, but there are also some other institutions that come in as people who can trade the foreign currency. As per the Foreign Exchange Management Act 1999, the Reserve Bank on an application may authorize any person to be known as an authorized person to deal in foreign exchange and is known as an authorized dealer, AD. There are three different categories of ADs: category 1, category 2, and category 3. So, who is a category 1 AD? Category 1 authorized dealers are select banks who can carry out all permissible current and capital account transactions as per directions issued from time to time. There are 106 authorized dealers of category 1 as per the RBI regulations. Who is a category 2 AD? Category 2 are select entities to carry out specified non-trade related current account transactions. All the activities permitted in full-fledged money changes and any other activity as decided by Reserve Bank. So who are the people who come in category 2? It's like some firms, companies who are all authorized to do the transactions. Category 3 ADs. Category 3 ADs are select financial and other institutions as authorized by the RBI to carry out special forex transactions incidental to the business and their activities. Who are they? For example, the Taj Hotel Group. You do have a lot of foreign visitors, so they are authorized for a transaction of foreign money. So they all come in category 3 authorized dealers. Now comes the full-fledged money changer. Who is a full-fledged money changer? Another category of an authorized dealer who can deal in a lesser way in foreign dealings are a full-fledged money changers. They have less functionalities like comparing to the authorized directors. FFMCs are registered companies to undertake the purchase of foreign exchange and sale of foreign exchange for specified purposes only, like private and business travel abroad. Who is a restricted money changer? Restricted money changer can only buy and not sell. Coming to FEDI. What is FEDI? FEDI is an organization that was formed in 1958. It is a self-regulatory body formed with the approval of RBI to take over the functions which was then undertaken by the Exchange Banks Association. So what is FEDI? FEDI is the Foreign Exchange Dealers Association of India. Everything has been provided in the slide itself. It was formed in 1958. It is a non-profit body which is approved by the RBI, and it is the Dealers Association of India. And it prescribes guidelines and rules for market operations, merchant rates, quotations, the delivery rates, holidays, and interest on defaults, etc. In terms of RBI directives, all authorized dealers are members of FEDI, and it is mandatory for them to follow the guidelines or directives issued by the FEDI. Some objectives of FEDI are associating with the RBI in promoting growth of India's external sector, associating with the export promotion councils, the chambers of commerce and industry, in order to administer Philip in India's international trade, contribute to the development of forex markets, promote best practices in conducting forex business, and formulating the uniform rules and guidelines for authorized dealers, ensuring a level playing field for the participants and harmonizing the interest. So that each and everyone gets a place in forex trading to help people, help India do a better trade in the forex market. What is the role of an of FEDAI or FEDI? It it is acting as a facilitator between the ADs and the RBI in handling the foreign exchange transactions by the ADs. It issues guidelines on various aspects related to forex. By articulating effectively India's viewpoint in various revisions and the ground rules of UCP URC, providing training to member banks on forex matters, granting accreditation to intermediaries, monitoring the broking activities in the interbank forex market, and administering of the benchmark rates like month-end revaluation rates of foreign exchange positions, daily US or IND closing rates for calculation of the war figures. Forex arithmetic. This is one of the most important part of this chapter. We will be going for a detailed video on this, and the next video will be comprising of all the arithmetic calculations only, which is of most importance and brings you almost 5 to 10 marks in the CAIIB examinations. So what is Forex? Forex is a commodity like any other commodity transaction. Foreign exchange transactions are of two types. Every transaction is of two types. In both, you have a purchaser, you have a seller. So Forex is also of two types. It's called purchase and sell. Whenever there is a purchase transaction, it is called a inward remittance. it is called a inward remittance. Whenever you are selling something, it's called a outward remittance. So what is a inward remittance? Bank receives inward remittances in foreign currency on behalf of their customers, either through the nostro channel or in the form of foreign currency notes or traveler's check. The inward remittances received gets converted at the instructions of the customer into rupees and credited to the customer's account at applicable purchase rates. This is what is called as inward remittance. What is outward remittance or the sell transaction? Bank receives requests from customers to make an outward remittances in foreign currency on behalf of the customers to the overseas beneficiaries, either through the nostro channel or to the customers themselves going abroad on travel in the form of foreign currency notes or the traveler's check. The outward remittances are affected to the debit of rupee account maintained by the customer with the bank, where the bank converts the rupee into foreign currency at the applicable selling rates. So, what is purchase? What is sales? What is purchased by a customer? What is purchased by a bank? What is sale by a customer? What is sales by a bank? We will go into a detailed video in the next upcoming video. It will be totally Forex arithmetic. Thank you. If you do have any questions, you can pass it on in the comment box. Do like, share and subscribe our channel for new videos. Thank you. Jai Hind.